So checking my phone, Palantir is currently trading at $26 billion. That's a far cry from the $1 trillion price tag I put on it back in November 2020. Now, if you stay till the end of this video, I'll explain exactly what needs to happen for Palantir to actually hit that $1 trillion market cap. That's not a joke. That's not clickbait. That's what I honestly believe in. Now, as always, don't click nothing, don't smash nothing, don't buy nothing, just listen. Now, I want to talk about a few things that are related to Palantir because over the past few days, naturally, there's been a lot of hoopla over Palantir. The stock has gone through an absolute rampage, a tear, and it's on everybody's minds. People are talking about it. Kathy Wood is buying back and Chicken Genius is selling. A lot of people are talking about it. Now, I was the original Palantir investor who talked about it on YouTube. I made my first video when it was $18 per share. Nobody was talking about it. And I immediately said, I think this has $1 trillion potential. People were laughing at me then. They kept laughing at me when it went to $7, etc., etc. Now, I've never changed my position on Palantir, but here's what I want to explain to you. I made a few videos over the past few days explaining why I think Palantir is running up too fast. I'm looking at the stock price right now, and it's up 100% year to date. In fact, it's up almost 57% basically over the past month. And that's too much. You can't have a stock go up by 50% over the past couple of weeks and just say it's normal and that's okay. Now, a lot of you have been asking me this question, which I want to address in this video before we go to the $1 trillion valuation. Tom, if you said back in November 2020 that this stock at $18 is cheap and it can go to $1 trillion, why are you now warning us that the stock price is running up too high when it's still below your entry point? It's currently at $12 or $13. You entered at 18. So the question is this a cognitive dissonance? Is this a contradiction? No, I'll explain. Look, when I was talking about Palantir, I'm talking about the valuation. A valuation is based on my DCF model, discounted cash flow model valuation. Now, based on the DCF, what we do, we essentially bring back from the future cash flows and we discount them to present values. Now, that discount process is dependent on interest. What is the interest rates in the market? That basically gives you that discount rate. The higher the discount rate goes, the lower the value of future cash flow in present value. It's very simple. Bigger discount, lower present value. Just remember it this way. Now, when we started doing these DCFs back in 2020, I just want to remind you that the interest rate was pretty much zero, and we could work with a DCF discount rate of 8 to 10%. Now, currently, the rate has gone up all the way to 5%, which means that we have to work with 12 to 14% discount rates, which means that the present values of the future cash flows of Palantir are now less valuable in this interest rate environment. That is why I'm telling you that things have changed. That is why you've seen multiples shrink. The stock market isn't accepting 40, 50 PE anymore, unless you're NVIDIA or Tesla, right? So multiples have shrunk because of that. And that is why 13 in this economy, in this interest rate, isn't the 18 in 2020. Now, that's something you have to understand. That doesn't mean that the stock isn't going to get there at some point. I honestly believe it will, but it's just here to tell you that the current valuation of Palantir is not $13. The market absolutely changed. The economy changed, the macro changed, the interest rates have changed, the discount rate has changed. So if you run a DCF model right now on Stock MVP, which is my platform, I'm going to put the link below. If you go and you run on our model and do a quick DCF model on valuation on Palantir, what you're going to get is, I'm just going to do it on the app. By the way, we have an app for this, so you can download it on the App Store, or, for your Android. So for a $10 stock price, you'd need about 500 million in EBITDA next year, which is far away from where they are right now. They're basically just almost broken even. So $500 million of EBITDA and an annual growth rate of 35% at a discount rate of 12%. So assuming they hit 500 million in EBITDA, which is not the case this year, and assuming they're going to grow at 35%, which they're not currently, it's a $10 stock. So for me, it's a very simple analysis. I'm looking at this, I'm saying, well, I haven't sold a single share. I got in at 18, I stayed the course, I bought more. I'm not going to sell it in the next 10 years. I don't care. But if I have to analyze this and look at the share price currently objectively, the share price right now with $13 is just way too high given the conditions. The stock has to grow into its valuation. Now, it might go to $20, $30, $40 on hype, which it did already. And it might not, I don't know. But if you want my honest opinion, currently it should be valued around 10 bucks. And when it gives us better quarterly results next time and next time and next time, it's going to slowly grow into a better valuation. That's how this should happen. When the stock just hype and just FOMO and just it gets ahead of its own honest valuation, fair market value valuation, I mean, it's unhealthy for the stock, and I don't like it as a long-term investor because, this isn't going to hold. Now, that's about that. Now, the second thing I want to talk about is the question I asked in the beginning. Is this a $1 trillion company? Now, I believe it is, but you have to understand what needs to happen for this to be a $1 trillion company. For this to be a $1 trillion company, here's what needs to happen. We need to get to about $10 billion of EBITDA. Now, EBITDA is very hard to get because EBITDA is not revenues. I mean, just to give you a kind of a general assessment of where we're at, Tesla has an EBITDA of about $3.5 billion. So for this company to get to $1 trillion, we need about 2.5 times of the current EBITDA of Tesla. Now, Palantir's revenues right now is about $2 billion a year. We're talking about 10 billion in EBITDA. So which means that this thing is at least probably 10 years away. There's no way this happens. Like realistically, optimistically, the fastest they can get to 10 billion EBITDA is 10 years. And that's going to be super fast. Even then, it assumes a 50 to 60% annual growth rate from that point on for the next 5 years after that. So if you think that Palantir can hit $10 billion in EBITDA with a 50 to 60% growth rate, and then it's a $1 trillion stock. Now, a lot of you will tell me in the comments, Tom, there's no way in hell that this company can do these numbers. And that's fine. This stock isn't for you. I believe it can. I just have the patience to wait 10 years and see it happen. I'm not in a hurry anywhere. Now, a lot of you may not have that time, and that's fine. Now, a lot of you have asked me what this thing is because you saw it on my desk in the last video. And it's not a sponsored video or anything. This is a Ridge wallet. This is the best wallet I ever had in my life. It has a money clip. And it has places for credit cards. It's been around the world with me everywhere I go. It fell off a roller coaster. It got hit by a car. It doesn't have a scratch on it. This thing is the best wallet I ever had. Shout out to Ridge. It's not a sponsored video. I don't know these guys. Never spoke to them. Amazing wallet. You should get it. And yeah, shout out to them. Ridge is the Palantir of wallets. I'll see you in the next video.